Earnings season kicked off with a bang today after big banks, JP Morgan, Citigroup, Wells Fargo, and Bank of America all reported earnings this morning. Here to break down those numbers is S&P Global Market Intelligence Director Nathan Stovall. Nathan, great to have you here with us. If we're kind of painting a broad stroke across some of the bank earnings this morning and extrapolating one thing that could be an underlying theme or a common denominator for the rest of the earnings season, what do you think that might be?
I think it really comes to the outlook. We thought Q4 was going to be pretty strong, and the results that have come in have supported that. We've seen strong revenue growth pretty across the board, strong loan growth, continued increases in deposit costs, but again, that was expected. But also really, really strong credit quality, no real deterioration yet. But the question was going to be, what was the outlook going forward? And what we've seen is not anything really negative, but as you were talking about earlier in the show, the outlook that now JP Morgan is baking in that expectation for a mild recession. So slower growth going forward, higher credit costs going forward. And I don't think it's necessarily that much negative, but you got to look at what the group was trading on leading up to this. Bank stocks had taken pretty great pressure most of 22, but we had seen a little bit of a rebound with perhaps the hope that maybe the Fed would pivot with the idea that they wouldn't want to push the economy into a recession. And now you've got some big bank executives saying that that is becoming sort of their base case. So going forward, I think that's really what the street is going to be focused on. What is the outlook for credit and really the broader economy going forward? I wouldn't say that it's necessarily that dire, but investors are hoping that it would be sort of continued blue skies.
So Nathan, if these stocks are going to trade off that recession call by JP Morgan and to a lesser extent Wells Fargo, so do you see more downside in the coming weeks to these names?
Well, when you look at where they're trading at historically, they're pretty cheap, arguably. So you could argue right now that the expectation for a recession is built in. We just had seen a little bit of a rebound in some of these names, JPM in particular. So when they come out and they throw out the expectation that you're going to see slower growth coming forward, I think that weighs on the name. But even more so, and you had mentioned this earlier on the show, the net interest income guidance came in a little bit lighter than was expected. And I think that that's a little bit weight on the stock too. But it really is going to be, what is the outlook relative to where people thought? Any sort of bit of bad news that kind of supports that negative bear case for the group, I think will add to some pressure. But it's not necessarily going to put severe pressure on the group.
Nathan, Julie here. The theory is that rising rates help the banks, right? That the net interest income tends to expand at times like this, even if the economy is slowing and that hits, say, deposit growth or loan growth. So talk to us about how you're thinking about how most of the banks have to balance those two this year and whether they're going to be successful.
Sure. And that's the name of the game. I mean, higher rates are good for banks, and we're seeing that play out in Q4. And ultimately, we think fundamental trends look pretty strong. But that balance of loans growing at a much quicker pace than deposits and deposits even sort of flowing out of the bank is the challenge that bankers have right now. And we're starting to see liquidity pressures arise, and that has been sort of the biggest thing and talking point that we've had over the last few weeks, not only in terms of deposit costs going higher, and we did see that play through on these big banks' results, but also the idea that maybe liquidity will be a little bit more fleeting. And we think that will continue to play out over 23, though we're not really in the camp that it's going to be as negative as some. So yes, there will be some outliers, but ultimately we've been in the camp that what you will see is that deposit rates will continue to go higher. That's good for consumers, but it's bad for bank margins. And so you get to a place where bank margins peak sometime this year. And thus far, we haven't really gotten any real clear read through to that, but the net interest income guidance from JP Morgan sort of supports that thinking that we're getting closer to a peak soon. And the banks that are able to kind of buck that trend and really hold the line on deposit cost are going to be ones that really significantly outperform going forward.